Hi everyone, and welcome to the first video review lecture for the session. In these video reviews, we'll be covering off on the main areas that were covered in the lecture in the previous week. They're not going to be a fully comprehensive version of the lecture, which is why it's a good idea to turn up to class, but we will look at the key points and the key things which we talked about. Now, we will be using the same slide deck, and no, this isn't scripted, so I'll try to edit out mistakes where they happen, but for the most part this will just be like me giving a shorter lecture, obviously not with people actually there. So in this topic we're looking at financial accounting and financial statements. So there are 5 objectives that we're looking to cover off in terms of topic 1. So firstly, looking at what accounting is and why it exists. Second, looking at the key financial statements, and these are the 4 main financial statements that we will be looking at over the course of at least the first half of the session. Third, look at the additional information provided in an annual report. Fourth, understand the regulatory environment that accounting operates in, especially in the Australian environment. And fifth, describe the qualitative characteristics of accounting. Now, starting off, funnily enough, at the start, with the objective of accounting. So what accounting is, and as talked about this with my classes, it's not just so that accountants have jobs and to keep us off the streets. What accounting is, as we've got listed here, is the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions. It is often, potentially a bit of a cliche, but it is often known as the language of business. Now, what I've put up on the image that you see here is from the Pathways Commission over in the United States. And there is this quite common perception of what accounting is, which is that it's very black and white. It is just certain things happen, and then just a whole range of rules get put in play, and there is just an inevitable output in terms of the financial statements that arises. Now, the reality of this is very, very different to what this perception is. And it's also one of the reasons, and this is a slight segue, that in recent years there's been some concern that accounting is going to be removed by artificial intelligence and machine learning. Now, I dare say that that will happen to some degree, and in the longer span of time, we may all be taken over by machines, but at least in the short to medium term, that's unlikely to happen. And the reason why it's unlikely to happen is that within the transition between economic activity happening, and so the things which actually take place in business, and financial reporting, which kind of provides that information out to the market, it's not just black and white. There's a huge amount of judgment that goes into play with this, and we'll start to see how some of this works in the next few weeks. But it is more complicated, and not just because the accountants have made it so, but it is more complicated than simply a thing happens and you account for it in just an absolute way. There's a lot of professional judgment, and even just around the numbers themselves, there's a lot of scope there for different decisions to actually take place. Now, the information isn't just provided, just again, as I said, to keep us off the streets. It's provided because people actually use it. And the fact that accounting has existed for so long would indicate that people do use this information, and they use it in 2 main sort of spaces. The first is those internal to the business, making business decisions. What prices to put on products, whether to continue with a product line, is a project a good idea or not. To external users who are looking to make investments within companies or between companies, looking to lend money to companies, and they want to do this in somewhat of a rational way. Now, what's important here, and even though as an accountant, this pains me a little bit, accounting information is not the be-all and end-all. It is an important part of the decision-making process, but it is not everything. So it is important to be aware of all the other sort of information sources around companies that you can have. Now, in terms of the course, external reporting, so financial reporting, is the first half of what we'll be looking at, so topics 1 to 6, and then we will move from topics 7 to 12 into the internal reporting. So we'll focus from here on in for the next, at least for today or this particular lecture, and for the next 5, we'll focus on financial reporting. So the objective of accounting, there are a number of assumptions that get made when preparing accounting information. These are, 1, the economic entity, and in this case this means that when we look at an entity, we are not looking at the entity and its owners and everything else that goes on. We're looking purely at the financial activities of the business separate from those of the owner. So for example, Jeff Bezos here from Amazon, obviously a major stakeholder within Amazon, shareholders, founder, and obviously really tied up with the company. But if we're looking at Amazon's performance, we would separate Jeff Bezos's income and his wealth and so on from that of Amazon, because when we're trying to determine whether or not Amazon is a good investment, we're interested in Amazon the entity, not Amazon and the owners. The second assumption, and this is a really important one, and often is the cause of some of the angst around accounting, which we will get to in the next 2 or 3 weeks, which is the time period concept. And what we effectively do is create arbitrary time periods, whether they be 12 months or 6 months. In the Australian context, if you're looking over in the US, they often do quarterly reporting as well. And this is because to be able to judge performance, you need a time period over which to do it. If you say a company has earned $1 million, if they did that over 10 years, that may not be that good. If they did that over 1 week, that may be a lot better. You can't actively compare performance without knowing the time period that you're dealing with. So with accounting, we do separate time periods into time periods. The third is that we do communicate this information, and that's what accounting is information. We do communicate this information in terms of monetary units. So we have a currency unit. So for example, in Australia, the Australian dollar is the most commonly used one. We use a currency unit as a means by which we communicate economic activity. Now, this isn't to say there's a lot of important things that happen within the business that aren't necessarily around currency units, but it is an important way in which we do create financial statements. And the last assumption that we have is that companies that we're dealing with, these will continue to operate into the foreseeable future. Now, the important reason for this is that if we don't assume that this is going to take place and that a firm is going to close down, is going bankrupt, is going into administration, it is likely that the asset values that that firm has will, well, at least on the books, will not be reflective of what they will actually be able to get in the market. And because of this, it just really throws out the financial statements. So for the most part, we assume that a company or a business or an organization will continue to operate into the foreseeable future. Turning now to the second objective, the financial statements, there are 4 key financial statements within a financial report. These are the statement of profit or loss, the statement of financial position, the statement of changes in equity, and the statement of cash flows. And we'll discuss each of these in turn using the Woolworths 2017 annual report. If you don't have a copy of this, please go and download it. It's often not often, it is a really good idea to be able to look on and just get a sense of where things are within the statements. So to start off with the statement of profit or loss, look, for most people, knowing whether an entity is profitable or an organization or a company is profitable is probably one of the key things. Certainly around financial reporting season, it's all about the profits that companies are making. And if you want to know how they're doing, then the statement of profit or loss is the place that you go. Now, technically, the statement of profit or loss and other comprehensive income, we are not going to be too concerned in this course about other comprehensive income. If you do have questions about it, I'm more than happy to answer them. So please post something up about them. Other names include the income statement, the P&L, statement of comprehensive income. If you hear me using these sort of terms, they're very much interchangeable for our purposes here. So a simplified version is simply revenue minus expenses, and that will give you profit, or things haven't gone so well, loss. So revenues are increases in resources resulting from the sale of goods or services. Now, what's important here is that two-part sort of component to it, which is that it's an increase in a resource. Now, it doesn't have to be cash, but cash is often a common one. So it's an increase in a resource, but the firm has done something for that. They've sold goods or services. If they had an increase in cash because the bank lent them money, that's not revenue. That's just an increase in resources because of a loan. Expenses are the reverse of that. Decreases in resources resulting from the sale of goods or services. So something, often things have to be given up or resources consumed to be able to deliver goods or services, and it's that linking between that sale happening and the decrease in the resource. So if inventory got sold, the firm has less inventory now, and that resource, the inventory, has decreased because the inventory had been sold. So that's the expense. Now this is obviously way too small. This is the consolidated statement of profit or loss from Woolworths. So what we'll do is we'll jump out. So the key things to note is this top line, these top few lines here are basically revenue. So we've got revenue, we've got total operating revenue. So if we think about the revenue section, this is basically revenue. If we then have a look at expenses, now if we kind of ignore other revenue here, which is a little bit annoying, we get rid of them. We have cost of sales, which is the cost of the inventory that you sold, branch expenses, admin expenses, financing costs, income tax expense. So these are all expenses. Now the only things in between them are subtotals, things like gross profit, EBIT, profit before tax, and other revenue, which is a small item, and it's there because it needs to be under gross profit. But in essence, we have revenue minus expenses, get rid of these, gives us profit or loss for the period. And in this case, they had a $1.59 billion profit, as opposed to a $2.3 billion loss the year before. And that is an example of a profit and loss statement for a major Australian corporation. The second statement we're going to look at is statement of financial position. Often we want to know how risky entities are, and what they're comprised of. So risk, often we look at things like leverage, which we'll discuss in later weeks. And the information that we can use to help us understand this is going to be in the statement of financial position. And this provides details of what a company controls and what it owes. So other names for this often are things like the balance sheet. So you'll often hear people use a balance sheet, which is interchangeable with the statement of financial position. Now, this statement is comprised of three elements: assets, liabilities, equity. Assets minus liabilities, the difference between those two is equity. Assets are economic resources that are objectively measurable, that result from a prior transaction and will provide future economic benefits. So, for example, a lot of things are assets, and obviously, if they're on the balance sheet, they are. So, something like a phone, if you've purchased a phone to do business, or a computer, or a tablet, that resource is objectively measurable because you can actually find the invoice for it and how much it cost you. It has come from a prior transaction. You do control it, and it will provide you future economic benefits because you'll be able to get to use the phone or the computer or the tablet to be able to call clients or communicate with clients or do business or whatever it is that you need to be able to do. What's often important in accounting, though, is also knowing what is on the balance sheet, but also what isn't. So lots of things which people find important, things like brand names, often aren't on the balance sheet because they're not objectively measurable. We can't put a value which is strong enough or reliable enough, at least for the accountants, to be able to put it on the balance sheet. There's no doubt that brand names like Coca-Cola's provide future economic benefits, and they certainly result from prior transactions, but because they're not objectively measurable enough, they get knocked out of being able to be included. Liabilities, now we're looking at, so I suppose, the other side of the balance sheet. Liabilities are obligations of a business that result from a past transaction and will require the sacrifice of economic resources at some future date. These are things which basically a business or an entity owes. So it's a present obligation. So something has to have happened. So that idea that it's from a past transaction is really important here. If you have purchased a phone and you have paid the supplier, you don't have a liability. If you have purchased a phone but you have not paid the supplier, you have a liability because you are obliged to pay the supplier for the phone that you have purchased. You have the phone, the transaction has happened, and you will have to give up cash to settle the liability. If, however, you intend to buy a phone in the future, there is no liability because there has not yet been a transaction. Even if you're really, really certain that you're going to do it, you do not have a liability at this point. Equity is simply the difference between assets and liabilities. And what this represents is the claim on the assets of the business by the owners. So basically, the owners are the last people who get a cut of the assets of the business. The liabilities all have to get dealt with, and then whatever's left goes to the owners. Again, quite small, so we're going to have a look at an actual statement. All right. So what we have here is a consolidated statement of financial position, or Woolworths balance sheet. So we'll look at assets first. And what we have is total assets of 22.9, so let's round it off, $23 billion. Now these are partitioned into current assets and non-current assets. Now, we're not going to go through them in detail here, but I'd urge you to have a look at these and have a look at the notes in relation to them and try to sort of understand what they are. These are common things which we'll come across, or lots of these are common things which we'll come across over the course of the next few weeks. Liabilities, current liabilities, non-current liabilities, total liabilities of about 13. So they've got roughly 23 billion in assets, roughly 13 billion in liabilities, which, if you do the maths, is roughly about 9.9, rounded off $10 billion in equity. So assets, liabilities, equity. Statement of changes in equity is the third statement. Now, equity represents the claims of the owners, as we've just discussed. And, owners are obviously interested in how their equity stake changes. And how we can find this is in the statement of changes in equity. Now, the equity or the statement of changes in equity, and I suppose equity, which is obviously a major part of that statement, equity is comprised of three main components: contributed capital, retained earnings, and reserves. Now, for this subject, we're just going to focus on retained earnings for this statement, but when we look at Woolworth's statement in just a second, we'll talk a little bit about each and what they mean. So retained earnings, as the name suggests, are the earnings which have been retained by the business. And I suppose by earnings we mean sort of the profits that they've made. So whatever opening retained earnings we start with, we add profits for the period. But then profits can be, I suppose, distributed as dividends to owners, and we take out from retained earnings any dividends which are paid. This means that the closing retained earnings is profit less dividends, so that opening earnings plus or minus profit or loss minus dividends. Typically in Australia, about 70% of profits are paid out as dividends, which is quite high. But if you've been following some of the debate recently about Labor's new dividend imputation policy, or sorry, not the imputation policy, but the changes to the refund, there's been a bit of discussion about why Australia has such a high payout ratio. What we see here is a consolidated statement of changes in equity for Woolworths in 2017. Now what we have here is share capital, which is contributed equity, shares held in trust, which are not something that we're going to worry about, reserves, which again are not something we're going to worry about in this subject, and retained earnings, which is something that we're going to worry about. That gives us a total. Don't worry so much about, not so much, don't worry about non-controlling interests. So what share capital is this is money, or I suppose proceeds provided to Woolworths by investors. This isn't shares that are trading on the market. This is where investors have actually provided capital to Woolworths itself. So there's been about $5 billion of this over the years to date, and a little bit extra has been put in through their dividend reinvestment plan. But the very big changes that take place in equity is very much in retained earnings. So in this case, we can see they started at about 3.1 billion. They added about $1.5 billion in profits, and they, I suppose not took out, but distributed about $860 million in dividends to end up with 3.8 billion in retained earnings closing. And really what retained earnings does is provide a link between the profit or loss statement and the statement of financial position. The final statement, and we really won't talk about it too much here because we will spend a whole topic on it in topic 5. This is basically providing not just the starting and ending balance of cash and cash equivalents, which you look on the balance sheet will be provided, but rather where all the money comes from and where it goes. So what we have are 3 types of activities: operating, investing, financing. This leads to a net increase or decrease in cash. We then add the cash opening balance to that, and we should get the cash closing balance as long as everything's been added up correctly. All right, so turning to the consolidated statement of cash flows, we have cash flows from operating activities, and we have about 3 billion provided there. Again, have a look through them, but basically operating activities are the things the business does to operate, funnily enough. Cash flows from investing activities is the second one, and in this case it's negative to the tune of $1.4 billion. Now, investing activities are primarily purchases or sales of non-current assets, so mainly things like property, plant, and equipment. And the final one is cash flows from financing activities, which is negative to the tune of 1.8 billion. And basically there are three things which get dealt with in financing activities. These are any movements in debt, any movements in equity, and dividends being paid. And you can see here that it's very much repayment of borrowings and payment of dividends which are driving this figure. And that gets you to a net decrease in cash of 40, let's round it off, $40 million, and ultimately leading to a cash and cash equivalents at the end of the period of about $917 million. And that's the cash flow statement. There's also a range of additional information provided by entities along with the financial statements. If you look at, say, Woolworths, that annual report or that financial report is about 130 pages long, of which the financial statements are maybe 5 or 6. So there's a lot of other information in there, other very important information which you really should be looking at. Firstly, there are the notes to the accounts. If you want to find out how Woolworths accounts for its inventory, or at how it accounts for revenue, or at how it does a whole range of different things and accounting choices it makes, that's what the 60 or 70 pages of notes are sitting behind the financial statements. Very, very useful to read. Secondly, the independent auditor's report. Now, it's important here that most companies by far and away do the right thing, but it is important to recognize that companies are providing their own information to the market, which they themselves prepare. What the function of the independent auditor is to go and, I suppose, verify the processes by which they've done that, and to be able to express an opinion as to how valid these reported numbers are. In Woolworth's case, certainly in 2017 and for a long time prior to that, they receive clean opinions, which basically means you can trust the information that they put in them. And that's very important. Now, what's relevant also with an auditor's report is it's not saying that a company is necessarily a good company. What it's saying is that you can trust what they're telling you. It could be a terrible company in the sense that they could be losing money hand over fist, but they're telling you that they're doing that, and that's what's important. So hopefully you can then make good decisions with that information. The third set of information, and this usually appears just before the financial statements, is the director's statutory report, which provides details of who the directors are and who the key management personnel are, what the entity does, how it's going, strategic directions, and so on. Again, really useful information to read. And usually right up the front, and generally a lot more colorful than the rest of the report, is the management discussion and analysis, which provides just a general overview of what the business is and where it's going. It's just important to recognize that obviously they are not going to be they're not going to be lying in any of these, and they certainly aren't doing that. But but companies are going to be expressing things in a way which is, I suppose, best for them. So it's good to read through this information and make sure that you're sort of cross-checking that with what you're seeing in the financial statements themselves and in the notes. The regulatory environment. Now, this is, for our purposes, a small part of what we need to do. Certainly, if you're going off and doing an accounting major, you need to be much more aware of this, and you'll come across this a lot more. But just to be clear, we in Australia use Australian standards, but those Australian standards are based on international financial reporting standards, and we have done so since 2005. These international standards are used in over 130 countries around the world, and they are set by the International Accounting Standards Board over in London. The Australian Accounting Standards Board, is based in Melbourne. They set Australian accounting standards, and these are based on IFRS. Whilst I suppose the AASB is not as critical to the process as what it was pre-2005. It is still a very important part of the standard setting process. They have a lot of communication into the IASB, and they do a lot of outreach with users and different groups within Australia. So it's an important information gathering body here, and ultimately they do actually set the Australian accounting standards. Both of these bodies simply write the rules, and they try to educate people on the rules, but they do not enforce the rules. That's usually that is left up to the different different governments around the world as to how they want to do that. And in Australia, it's ASIC, the Australian Securities and Investments Commission, which is tasked with ensuring compliance with the corporations law and also Australian and therefore the Australian accounting standards. And finally, if a company is a listed company in Australia and say they're listed on the Australian Stock Exchange, they must meet the listing rules of the ASX, and that there are a number of rules in there, which please feel free to go to the ASX website to have a look at what they are. And finally, the qualitative characteristics of accounting. Now, accounting information should be understandable, although I would hazard that if a lot of people would open up a financial report, they would find that mind-bogglingly complicated, and so it's not necessarily understandable to anyone. It's understandable to those who have put some time in, and a reasonable amount of time into studying it. By the end of the next 6 weeks, you will be in the boat where you can understand most financial statements. Not all, and not all the details of them, but you will have a pretty good grasp of what you're looking at. Accounting information is about helping people make decisions, and so that information should have the ability to affect decisions. If it doesn't, if it's immaterial to that, if it's not relevant, then it's not really all that helpful. So, for example, price information, or value information of something from 30 years ago is probably not that relevant to a decision that needs to be made now. And so that's an important aspect of what accounting information should be. But then in a way that sort of plays off against what the next characteristic is, which is reliability. And that means that the information which is presented, we can have some level of certainty that it is actually what it purports to represent. And you see examples of this with a whole range of things outside of accounting. So a lot of websites now, or movies or books or whatnot, hotels, have people rate them. But if you have a company, or if you have a restaurant which basically pays a whole bunch of people to rate their restaurant favorably when they probably shouldn't have been doing that, if I make a decision to eat at that restaurant, I'm probably not going to enjoy the experience. And that's because what I read on the ratings is not actually representative of the quality of the restaurant itself. And so I've made a bad decision based on unreliable information. The same holds true with accounting. If the information we're providing, or companies are providing, is not reliable, people will make bad decisions. Ultimately, accounting information should be comparable across different businesses. What this means is if businesses are doing similar things, they should be using similar accounting methods, which, from a financial reporting point of view, really rolls up to the standards and what allowable choices companies can make. We need to be able to let them to make certain choices, but if we allow them to do basically anything, it's going to be very hard to compare between sort of Woolworths and Coles, for example, or Qantas and Virgin, or name two different businesses, because the way their numbers are constructed may be very, very, very different. And ultimately, I don't have unlimited amounts of funds. I need to make decisions amongst where I invest my finances. So that was the previous example was in relation to comparability between companies, but in a way, consistency is comparability over time within the same company. So if a company uses a certain method, for example, FIFO for inventory, which we haven't discussed yet, but we will in a few weeks, they use FIFO for 1 year, we'd like them to keep using that same method year on year so that we can get an accurate representation of how inventory has been going within the business. If they keep choosing different things, it's very hard for us to be able to look back and say, well, this is how they did here, and it's and compare it to the previous year. Materiality is the threshold over which an item could begin to affect decisions. Now, I'm not going to flip back to it at this point, but if you go and have a look at the Woolworths financial statements, the decimal point is $100,000. So 0.1 is $100,000. Anything less than $50,000 doesn't even appear in the financial statements. Even a decimal point there, if you look at their profit, there's 1.5 billion. If it was $1,000, $2,000 here or there is not material to an investor's point of view. But that's because it's a really big business. If you had a small business, a startup, $100,000 could be a really important thing. So materiality isn't necessarily a dollar figure. It may also not be necessarily a percentage figure. There's a level of judgment there as to what is material for different businesses. And the last qualitative characteristics, and that this will wrap things up, is that if there is uncertainty, and as we're going to see, there is lots of uncertainty in accounting information, accounting should, and I'll stress should because it doesn't always, but accounting should present the least optimistic alternative. So the idea being here is that if something is not going to go well, then we should be showing that, as opposed to if something's we think it's going to go well or really well, we need to be a lot more sure that that's going to happen. So if any surprise is going to take place, it should be a surprise in the positive sense, not in the negative. And that wraps it up for this first video review. If you've got any questions coming off the back of this, if there are things that you're still not too sure about, please use the discussion board, or just send me an email or get in touch with me, and we'll figure things out. So thank you for listening, and look to the next one in about a week's time.